Welcome and thank you for standing by. All participants will be in a listen-only mode for the duration of today's conference. Today's call is being recorded. If you have any objections, you may disconnect at this time. Now I would like to introduce Mr. Daniel Bean.
Thank you. Good afternoon, everyone. Welcome to today's Risk Analysis Center presentation entitled Brokered Deposits and Interest Rate Restrictions. There will be discussion by our presenters, and the question and answer session will be held via email. If you would like to ask a question by email during the presentation, please send your request to rac@fdic.gov. That's rac@fdic.gov. I would like now to turn this call over to Mindy West, Chief, Division of Supervision and Consumer Protection.
Thank you, Dan. I'd like to welcome you to this discussion and presentation of brokered deposits and interest rate restrictions. Thank you for participating on this call. This topic has generated a lot of interest and many questions during our industry outreach events, particularly in light of the recent revisions to the interest rate restrictions outlined in Section 337.6 of the FDIC Rules and Regulations, which goes into effect January 1st, 2010. Although Section 337.6 is of primary concern to banks that are less than well capitalized, it's important for all banks to be familiar with this regulation and its requirements. We thought this would be a good time to give you an overview of issues concerning brokered deposits in general, as well as the new requirements. During this call, we will discuss some of the changes communicated in a financial institution letter we sent out last Friday, FIL 69-2009, that describes the process for determining high rate areas under the interest rate restrictions contained in FDIC Part 337.6. I'd like to thank our presenters today, Greg Patone, who is the Assistant Regional Director in our New York region, Becca Berryman, who's Senior Capital Markets and Securities Specialist in our Atlanta Regional Office, Lou Burvid, Senior Examination Specialist in our Policy Group here in Washington, Martin Thompson, Review Examiner, also headquarters Washington, and Chris Henke, Counselor from our Legal Division, for participating on this call. Each of our panelists will make some remarks about brokered deposits and the interest rate restrictions, as well as provide information regarding filing a request for determining if an institution is operating in a high rate area under Part 337.6. We will then open it up to take your questions and answers via email. We are recording this call today, and we will make a transcript of this call available on the FDIC.gov website probably around the first of the year. With this, I'd like to turn it over to Lou.
Thank you, Mindy. Today's presentation will start by clarifying the definition of brokered deposits. That segment will include a discussion of CDARS deposits, sweep accounts, internet deposits, and deposit listing services. We will then review which banks are impacted by the brokered deposit and interest rate restrictions contained in Section 337.6, as well as providing an overview of broker deposit waivers and interest rate restrictions. We will close the presentation by providing an overview of what to expect during examinations for banks impacted by this regulation. After concluding the presentation, as Mindy mentioned, we will have a question and answer period where you will be able to submit questions by email. Send your questions to rac@fdic.gov and include the words broker deposits in the subject line. When we respond to the question, we will not identify the person or institution asking the question. We will start the presentation by clarifying who are considered deposit brokers and what account types should be included in broker deposit balances. Who is a deposit broker? A deposit broker is any person engaged in the business of placing deposits or facilitating the placement of deposits of third parties with insured depository institutions. Deposit brokers also include any insured financial institution that is not well capitalized and any employee of those institutions who engages directly or indirectly by offering deposit rates that are significantly higher than the prevailing rates of interest in the bank's market area. In addition to accounts commonly reported as broker deposits, many institutions may have additional funds that should be included in this category. We have received questions regarding the inclusion of internet deposits, deposits from listing services, CDARS deposits, and sweep accounts. Becca will now discuss the inclusion of these accounts as broker deposits.
I'll start by discussing CDARS deposits and other deposit placement services. Deposits received through a deposit placement network, such as the CDARS program, are broker deposits and should be reported as such on the reports of condition. These deposits can be obtained on a reciprocal basis or through a one-way buy program. As a reminder, these balances are subject to the same interest rate restrictions as all other deposits. Banks eligible to apply for a waiver may include these balances in a broker deposit waiver application. Only if the waiver is granted, the bank would then be able to accept, renew, or roll over these deposits. Sweep accounts are another deposit grouping included as broker deposits. These accounts are reported as broker deposits unless the bank requests and receives a primary purpose exemption from the FDIC. The bank will receive this exemption only after review and the decisions are made on a case-by-case basis. Reasons: the sweep account program must meet all of the following criteria before a primary purpose exemption would be considered. Funds cannot be swept into time deposit accounts. Fees paid by the bank are flat rate fees and not based on the number of accounts or the balances contained in the accounts. The amount of swept funds does not exceed 10% of the total brokerage funds of the customers in the sweep program. Total brokerage funds include investments, uninvested cash, and sweep balances. For additional information, please refer to the FDIC Advisory Opinion number 05-02 dated February 3, 2005, which is titled, "Are Funds Held in Cash Management Accounts Viewed as Broker Deposits by the FDIC?" I'll now move into a discussion of Internet listing services and deposit brokers. Internet deposits may or may not be considered broker deposits. Because deposit brokers may utilize these services, banks need to ensure that they are aware of the source of funds and report the balances appropriately. In other words, if the deposit provider is a broker, the funds should be reported as broker deposits on the call report. In addition, any funds acquired through the Internet, whether brokered or not, are subject to the interest rate restrictions if the bank is subject to Section 337.6. A deposit listing service is a compiler of information about deposits, and deposit brokers are facilitators in the placement of deposits. In general, a deposit listing service is not a broker if all of the following FDIC criteria are met. The service compensation consists solely of subscription fees for gathering and listing of rates. In addition, the listing service does not require an institution to pay for other services as a condition to being listed. Any fees are flat fees and not calculated on the basis of the number of accounts or volume of deposits. The listing service performs no services except the gathering and transmission of information between depositors and the depository institutions. Any funds to be invested in deposit accounts are remitted directly by the depositor to the insured depository institution and not directly or indirectly by or through the listing service. All funds acquired through a listing service are subject to the rate restrictions. I've covered a lot of information here, but an important thing to note is that a deposit listing service just lists rates and shares information. The easiest way to think about deposit brokers is that there is someone between you and the deposit provider. I'll now turn over the presentation to Greg to provide an overview of the assessment changes on broker deposits.
Good morning and good afternoon. I'm going to cover a topic that has resulted from the implementation of the revised deposit insurance assessment procedures. Beginning with the second quarter 2009 assessment process, the amount charged for broker deposits was changed. For Category 1 institutions, which generally have a composite rating of 1 or 2 and are well capitalized, the FDIC introduced a new financial ratio into the financial ratios method, and that's called the adjusted broker deposit ratio. This ratio is intended to measure the extent to which broker deposits are used to fund rapid asset growth. This new ratio affects institutions whose broker deposits are more than 10% of domestic deposits and whose assets are more than 40% greater than 4 years previously. Institutions in risk category 1 can exclude CDARS and other similar deposits obtained on a reciprocal basis from the adjusted broker deposit ratio. However, broker deposits that are swept into an institution are included in the ratio. An institution in risk category 2, 3, or 4 will be subject to an assessment rate adjustment for broker deposits referred to as a broker deposit adjustment. This adjustment will be limited to those institutions whose ratio of broker deposits to domestic deposits is greater than 10%. Asset growth rates will not affect this adjustment. The adjustment will be determined by multiplying 25 basis points times the difference between the institution's ratio of broker deposits to domestic deposits and 10%. However, the adjustment will never be more than 10 basis points. It is important to note that for this adjustment, broker deposits include reciprocal deposits and sweep deposits. This concludes the first part of our presentation. The next segment includes an overview of the revisions to Section 337.6 and clarification on which banks are impacted by the regulations limitations, as well as revisions to the interest rate restrictions, requirements for filing a broker deposit waiver, and calculation of the applicable market rate. So what is Section 337.6? It is the regulation that implements Section 29 of the FDIC rules and regulations called broker deposits and restricts the use of broker deposits and sets limits paid on interest-bearing deposits by less than well-capitalized FDIC-insured institutions. So why was the rule revised? The revisions were made to bring the restrictions in line with the regulation's intent and to simplify the process for determining conformance. The intent of the regulation is to prevent banks from circumventing the prohibition of accepting broker deposits without the assistance of a deposit broker by offering high rates. In addition, the low yields on U.S. Treasury securities compress the national rate caps computed under prior regulation. Therefore, the national rates fell well short of the actual paid on certificates of deposit by banks. Given the increasing use of Internet deposits, the final rule also addresses difficulties in determining the origin of the deposit and calculating the prevailing rates paid within that market area. The national rate is now defined as a simple average of rates paid by all FDIC institutions and branches. The national rate should be used to determine conformance with this regulation by all banks unless the bank has requested and received a determination from the FDIC that it is operating in a high rate area. The prevailing rate for institutions with a high rate determination is the average of rates offered by other FDIC institutions and branches in the bank's local geographic area. Rates offered by credit unions can be included in this calculation if an institution can support that it competes directly with these institutions for deposits. The national rates are updated weekly and posted on the FDIC website. The link can be found in FIL 69-2009, which was issued last Friday and is accessible at fdic.gov. Now that we've provided an overview of the revised rule, what banks are impacted by Section 337.6? Applicability is determined by the bank's capital category as defined by Section 38 of the FDI Act and Part 325 of the FDIC rules and regulations. There are two major categories of banks impacted by this regulation. The first group includes adequately capitalized banks and well-capitalized banks under a formal enforcement action with a specific capital provision. These particular well-capitalized banks are considered adequately capitalized for the purposes of Section 337.6. Banks in this group cannot accept, renew, or roll over broker deposits without a waiver from the FDIC. In addition, they cannot pay interest rates above the applicable market rate. The second group includes undercapitalized, significantly undercapitalized, and critically undercapitalized banks. These institutions cannot obtain a broker deposit waiver, and they are also subject to the interest rate restrictions in Section 337.6. As a result, the acceptance of deposits with rates significantly exceeding the applicable market rate is a violation of 337.6. The next section of the presentation discusses the implementation of the regulation. First, I will discuss broker deposit waivers. Who can receive a waiver, and when assessing a waiver application, what factors are considered by the FDIC? Broker deposit waivers are only available to adequately capitalized institutions. Well-capitalized banks do not need a broker deposit waiver. However, for the purposes of this regulation, well-capitalized banks under a formal enforcement action with a specific capital provision are considered adequately capitalized and therefore must obtain a waiver before holding broker deposits. To request a waiver, a letter application should be submitted to the appropriate FDIC regional office for review. Applications are evaluated on a case-by-case basis and are not automatically granted. Waivers are generally approved for no longer than 90 days at a time. Contingency waivers are not processed, and as a result, banks should submit applications only after becoming subject to Section 337.6. Waiver applications are evaluated for traditional safety and soundness concerns, including the institution's capital position, asset quality, liquidity levels, and earnings performance. Institutions that do not have a viable plan for returning to well-capitalized status or are experiencing negative trends towards undercapitalized status are not likely going to be granted a waiver. The region will also assess an institution's contingency funding plans related to lines of credit with other corresponding banks and government agencies, as well as current business plans to expand or grow. Another significant provision in Section 337.6 involves interest rate restrictions for banks that are less than well capitalized. Lou will now provide an overview of the interest rate restrictions and high rate market determinations.
Thanks, Greg. Section 337.6 restricts the use of broker deposits and limits rates paid on interest-bearing deposits by less than well-capitalized FDIC-insured institutions. Deposits solicited by these institutions cannot significantly exceed the prevailing rates in the applicable market. The applicable market rate is the national rate for all banks until they request and receive a high rate determination from the FDIC. The FDIC has interpreted significantly exceeds as meaning more than 75 basis points. Once the rule is effective, an institution that believes it is operating in a high rate area will be able to use the prevailing rates in its market area to determine conformance only if it seeks and receives a determination from the FDIC that it is operating in a high rate area. With or without the high rate determination, institutions must use the national rate to determine conformance for all out-of-area deposits beginning January 1st, 2010. How can a bank obtain a high rate determination? To obtain a high rate determination, banks will be asked to submit information regarding their market area in letter form to the applicable regional office. For determination requests received by December 31st of this year, a response will be received by January 30th, 2010. For institutions that submit the determination request by December 31st, 2009 and are determined to not be operating in a high rate area, begin using the national rate caps to determine conformance with local deposits by March 1st, 2010. Institutions submitting determination requests after December 31st, 2009 will have to begin using the national rate caps on January 1, 2010 until they have received a determination from the FDIC that the institution is operating in a high rate area. As previously stated, banks can only use the local market area approach if they have requested and received a high rate determination from the FDIC. The determination will be effective for the calendar year, but will be rescinded by written notice from the FDIC if the institution's market area is determined to no longer be in a high rate area. Becca will continue the implementation discussion by reviewing issues surrounding calculating the local market average.
The first issue I'll cover is how is the prevailing rate calculated. After receiving a high rate determination, the bank will use a local market approach with the calculation based on all rates paid by all FDIC insured institutions and branches within the bank's geographic market area. The prevailing market rate is calculated for deposits based on maturity and size of the deposit. In addition, banks should exclude their own rates from calculating the market average. Credit unions may be included in the calculation if the bank can show that these institutions impact the rates being paid in the market area. Prevailing rates are calculated by averaging rates paid by account type, maturity, and account size. For example, the bank's money market account rates are compared to the average rate for its competitors' money market accounts. These accounts could include all tiers of money market accounts as well as special rates, products, and relationship accounts. For deposits with the same maturity structure, the prevailing rate is calculated based on jumbo, which includes accounts with balances $100,000 and greater, and non-jumbo status, accounts with balances less than $100,000. No other divisions based on deposit size are permitted. The final rule allows the segregation of savings accounts, NOW accounts, and MMDAs for evaluation purposes. However, additional account bifurcation for special features is not allowed. Another common question is why are branches of other banks included in determining the prevailing rate? Individual branches of other institutions are considered to be competitors soliciting deposits within a market area. The new rule defines the national rate as a simple average of rates paid by all insured depository institutions and branches for which data are available. Excluding branches for calculating the prevailing rate for a local market would be inconsistent with the methodology used to calculate the national rate under the new rule. Institutions should use the all banks, all branches methodology under the revised regulation. So what rates do I use? When comparing the actual cost of broker deposits to the applicable market rate, banks should use the all-in cost paid by the bank rather than just the stated rate. The rate should be consistent with the requirement for reporting interest on deposits on the reports of condition and income. Call report instructions state that banks should include as interest expense finder's fees and broker's fees that represent an adjustment to the rate paid on deposits. Another set of questions relates to the treatment of uncommon account features and promotional rates. The final rule allows for segregation of savings accounts, NOW accounts, and money market deposit accounts for evaluation purposes. However, accounts cannot be segregated based on special features, including tiers other than jumbo and non-jumbo, account relationships, or other features not regularly provided by the institution. Promotional rates are included in the average, with accounts having similar maturity and size. Many institutions have argued that artificially low rates should be excluded from the calculation. However, the low nature of particular rates is not reason enough for exclusion, and the rate should be included in the calculation of the prevailing rate. I will next review a couple of examples of market rate calculations. These examples are available in the field that we issued last Friday. The first example shows a calculation for the prevailing rate for deposits under $100,000, non-jumbo. In this example, the bank has two tiers for their deposit, a $10,000 tier with a rate of 1.2% and a $50,000 tier with a rate of 1.5%. You also can see in the example that the bank has rates from two different competitors. One of their competitors has one branch, and another competitor offers two tiers for a similar maturity account. Bank A is offering two tiers similar to the example bank. Bank B only has one tier of deposits, but it has two offices within the example bank's market area. As you recall from previous parts of the discussion, rates from all the branches and all the tiers of deposits are included in the below $100,000 non-jumbo calculation. The average market rate is then calculated using all banks and all branches within the geographic area. In this case, it would include the four rates being offered by the two other institutions. The average rate for this product is 0.7, which results in a rate cap of 1.45% after adding 75 basis points. When comparing that rate cap to the bank's rate, note that the rate on the $10,000 tier is below the rate cap. However, the rate on the $50,000 tier at 1.5% is above the 1.45% rate cap by 5 basis points and should be adjusted. So what do you do then if you have a deposit product that is a non-standard maturity, such as a 10-month CD? There is another example provided in the Q&A to address this issue. Because many market areas offer products that are not one of the standard maturities, we've included an example in the Q&A document that illustrates the interpolation process. In this example, banks in the market area offer a 9-month and a 12-month CD. The example bank, however, wants to offer a 10-month CD, which does not have comparables in the market. To obtain a comparable rate, find the difference between the two commonly offered rates. In this example, that difference would be 30 basis points, which is the difference between the 9-month rate of 0.9% and the 12-month CD rate of 1.2%. The second step is determining the per month amount of that difference. 30 basis points is divided by 3 because there are 3 months between the maturities of the two commonly used rates. To obtain the 10-month comparable, add the 1-month difference of 10 basis points to the 9-month rate of 0.9%. The comparable rate then would be 1%. The rate cap for the 10-month CD would be 1.75%, or 1% plus 75 basis points. I suggest if you have questions about this to review the Q&A document. The steps are clarified in that document. Okay?
Okay, to close out the presentation, we will discuss the treatment of high-rate accounts that existed prior to the institution becoming subject to Section 337.6 and what to expect during examinations. Many institutions impacted by Section 337.6 have accounts with rates that significantly exceed the applicable market rate. The rates on these accounts should be adjusted to within the applicable limit as soon as the accounts are renewed or rolled over. As a result, rates on CDs can continue to be paid until the maturity of the deposit. However, rates on non-maturity accounts should be adjusted as soon as 337.6 becomes applicable. Any account with a significantly higher than market rate should be reported as a broker deposit only if it has been acquired, renewed, or rolled over since the institution became subject to the rate restrictions. So what should you expect during examination if your bank is subject to Section 337.6? For banks able to use the local market approach, examiners will review their internal rate monitoring system to ensure that the bank is using the appropriate market rate and is including all banks and branches within the market area in their calculation. Examiners will also review out-of-area deposits to ensure compliance with the national rate cap. For banks required to use the national rate, examiners will review the bank's monitoring system to ensure compliance with the regulation. In both cases, the compliance documentation should be available for examiner review at any point in time. Examiners will use this documentation to verify the level of broker deposits reported on the call report. When reviewing the liquidity component, examiners will assess an institution's reliance on brokered, wholesale, and other volatile funding sources, such as what Mindy indicated in her opening remarks. Examiners follow our Manual of Examination Policies, which says that the use of wholesale funding is not viewed negatively. However, we will review a bank's use of brokered and other wholesale funding relative to its business plan, its overall risk profile, its capital category, and its contingency planning activities. It is generally shortfalls in these other areas that lead to examiner criticism of a bank's reliance on brokered funding, not just the level of brokered funds or the non-core funding dependency ratio. Per Financial Institution Letter 13 in 2009, the use of volatile or special funding sources by financial institutions that are a weakened condition, FDIC supervised institutions, regardless of rating, that rely excessively on a volatile funding mix are subject to heightened off-site monitoring and more extensive on-site examinations. Institutions rated 3, 4, or 5 are expected to implement a plan to stabilize or reduce risk exposure. Examiners will also review the institution's contingency funding plans, which should detail an institution's response to stress scenarios, including changes to the bank's PCA capital category, which impacts the applicability of Section 337.6, adverse publicity, and business disruptions due to natural disasters. The contingency funding plan should include definitions of responsibilities and decision-making authority so that all personnel understand their role during a problem funding situation, an assessment of the possible liquidity events that an institution may encounter, details on how management will monitor liquidity events and conduct stress testing, triggers related to broker deposits and other funding sources, and identification of backup facilities. This concludes the third major topic of our presentation.
I want to quickly summarize the key points from today's presentation. CDARS deposits are broker deposits. Swept accounts are broker deposits unless the bank receives a primary purpose exemption. Section 337.6 does not apply to well-capitalized institutions. Less than well-capitalized institutions are subject to Section 337.6. Remember that this would include well-capitalized banks under a formal enforcement action with a specific capital provision. They're therefore deemed to be adequately capitalized. An institution subject to Section 337.6 must adhere to the national rate cap unless it requests and receives a high rate determination from the FDIC. Banks using the local market approach must include all banks and branches from their geographic market area in the analysis. Institutions subject to interest rate restrictions must use the national rate for out-of-market deposits. Contingency funding plans should address the impact of Section 337.6 restrictions. We are now ready for the question and answer section of our presentation. Please submit your questions to rac@fdic.gov. That's rac@fdic.gov, and include the words broker deposits in the subject line. We've received a number of questions in advance of the presentation, so we're going to start with those. The first question asks, if we send in our letter of request to be considered to be operating in a high-rate environment before 12/31/09, are we allowed to use the local area market rates we have requested during the time we are waiting for our response from the FDIC on our request? The answer is yes. For local area deposits, you can use the prevailing rate in your local area, and you would add the 75 basis points to that to determine the rate cap. But as of 1/1/2010, you must start using the national rate caps. Again, that's the national rate plus 75 basis points, which is posted on our FDIC website for all non-local deposits. Here's another question. If a bank applies for a high-rate market determination from the FDIC, but does not receive an answer before January 1st, what rates should the bank offer after January 1st while awaiting the FDIC's response? Actually, institutions will hear from the FDIC by January 30th, and will have until March, the institution will have until March 1st to start using the national rate if it's not considered to be operating in a high-rate area. So you'll receive our response by the 30th of January. So you have a couple of months leeway here, but you don't have to start using it if the national rate for local deposits, if you submit that application or that determination request, I should say, by the 31st of December. The second question, for banks that receive the determination from the FDIC, who is responsible for calculating the local market prevailing rates? The institution is responsible for calculating the prevailing rates to ensure they're in conformance with the interest rate restrictions. We won't be doing that for you, and then examiners will review that information once they come on site during examinations to ensure that the institution is conforming with the interest rate restrictions. Another question, if an institution is found to operate in a high-rate market, will it automatically be allowed to use its market rates for setting interest rates? If not, what other factors will the FDIC consider when making the determination? Yes, the prevailing rates in the local market can be used for local deposits. The FDIC will only consider standardized data, however, when making the determination. And we talked a little bit about that. It'll be either by state MSA or micro SA.
Okay, I've received a question about how would the national average be determined for money market accounts when we offer different interest rate tiers depending on the balance in the account. Just as a reminder, the only split we allow is for jumbo and non-jumbo. So when you're calculating the local market average, accounts with required balances less than $100,000 are in the non-jumbo calculation, and accounts with balances that are required to be $100,000 or above would be in the jumbo balances. So several different tiers may be in each calculation, and there's not a separate calculation by tier other than jumbo and non-jumbo. Another question is, are credit union rates included in the market area averages? For the national rate calculation and the high rate determinations, they are not included. However, if you do receive a high rate determination and can show that credit union rates impact the local market area and your competitors' rates, you can include them in that analysis. The next question I got are the rates on odd-term time deposits monitored and regulated under this rule. And also, what about rewards checking? There's some good information in the Q&A on odd-term or non-standard term deposits and how those calculations. I went over a couple of those pretty quickly, but the Q&A shows you how to use interpolation for accounts that are between two standard maturity accounts, and that's how we monitor that, both on the national rate basis and on the local market analysis. And accounts such as rewards checking or other special type of accounts are included with all other checking accounts when calculating the market average.
Cal, I have a few here. If an institution is considered well capitalized, are there any events that would cause that institution to have to comply with broker deposits and interest rate restrictions? And the answer is, if you're well capitalized, the only way that this would be applicable to you is if you were under a formal enforcement action with a specific capital provision that would which would make you adequately capitalized, and therefore you have to obtain a waiver before you have broker deposits. Another question, if you are under a memorandum of understanding or a board resolution that has a capital ratio stated in there, are you required to get a waiver? And the answer is no, because you're not under a formal enforcement action such as a cease and desist order or a consent order. I have another question here. A bank that is under a written agreement with their state regulator and the Federal Reserve, and the bank meets the well-capitalized standard condition. The agreement does not specify any specific capital directive other than requiring a plan, and the FDIC has not issued a capital directive to the bank. And I draw your attention back to the statement that we made a couple times here that if a bank is well capitalized and they're under a formal enforcement action which a written agreement would qualify, there has to be a specific capital provision considered in the formal agreement, and that would make you adequately capitalized, and therefore you would have to obtain a waiver.
Okay, I have a question here. It says, please provide a specific example of the use of national rates versus rate caps as shown on the weekly national rates and rate caps table. For example, absent a high rate area determination by the FDIC, is compliance defined by the national rate column or the rate cap column? Does a high rate area